In the summer of 1991, India was facing its worst economic nightmare. The country had run out of foreign currency reserves, leaving it unable to pay for essential imports like oil. The government was effectively bankrupt, teetering on the edge of a sovereign default. The roots of the crisis were deep. Throughout the 1980s, India had been spending more than it earned, relying on heavy borrowing. When the Gulf War broke out, oil prices skyrocketed, and remittances from Indians working in the Middle East dried up, putting immense pressure on the exchequer. By June 1991, the Reserve Bank of India's forex reserves had dwindled to just over $1 billion. This was barely enough to cover 3 weeks of imports. For a nation of hundreds of millions, this was a terrifyingly thin safety net. The crisis was exacerbated by political instability. With a fragile government in New Delhi, international credit rating agencies downgraded India's debt. Investors were pulling their capital out, and the country was officially labeled a high-risk destination. To survive, the RBI had to take drastic, unprecedented action. In a move that shocked the nation, the government decided to airlift India's gold reserves to London and Switzerland. This was the collateral needed to secure an emergency loan from the Bank of England and the Union Bank of Switzerland. The image of 47 tons of gold being loaded onto planes remains etched in the memory of that generation. It was a humiliating moment, but it was a necessary sacrifice to convince the world that India intended to honor its debt obligations. With the immediate threat of default paused, the government approached the International Monetary Fund, or IMF. The IMF agreed to a bailout, but it came with strict conditions, a complete restructuring of the Indian economy. Finance Minister Manmohan Singh, under the leadership of Prime Minister P.V. Narasimha Rao, presented the landmark 1991 budget. It signaled the end of the License Raj, a complex system where the government controlled almost every aspect of business production and imports. The reforms were swift. The government devalued the rupee to make Indian exports more competitive, slashed import tariffs, and opened the doors to foreign investment. The focus shifted from state-controlled planning to market-driven growth. The RBI played a crucial role in managing the transition. They had to stabilize the volatile rupee while simultaneously tightening monetary policy to control double-digit inflation. It was a tightrope walk between austerity and growth. Slowly, the numbers started to move in the right direction. Foreign exchange reserves began to climb as investor confidence returned. The structural reforms gradually integrated India into the global economy, setting the stage for the IT boom of the late 90s. The lesson from 1991 is clear: a country's economic health is not just about domestic production, but about its ability to participate in global trade and maintain a sustainable balance of payments. It taught India that openness and fiscal discipline are the foundations of modern national security.